Hello and welcome to the Owner Finance Academy, where we help Canadians build wealth by buying U.S. real estate and selling with owner financing. Before we begin, a quick reminder that everything shared on this channel is for educational purposes only. Every situation is different, so always consult a qualified legal, tax, accounting, and financial professional before making your financial investment decisions. In this lesson, we're going to look at how much money you actually need to get started investing in U.S. real estate using the slow flip strategy. By the end of this video, you'll understand the different sources of startup capital, why reserves are important, and how to realistically determine whether this strategy fits your financial situation so you can make a better decision and get started with confidence. Let's get started. So, how much money do you need before buying your first U.S. slow flip? Look, there isn't a magic number because everyone's financial situation is different, but by the end of this video, I'll try to give you an estimate based on the price range for the purchase of the property. Some people have cash available. Others use a home equity line of credit. Some work with private lenders from the very beginning as their sources of fund. I've used different sources of financing over the year, and depending on the deal and where I was in my investment journey, the right tool depended on the property. The first thing I like to have in place is my financing. Once I know how much capital I have available, I know what type of properties I should be looking at. It keeps me disciplined because I'm buying within a plan instead of chasing whatever happens to come onto the market. I personally don't like finding a property first and then trying to figure out how I'm going to pay for it. That's usually where people start stretching themselves, accepting financing and financing terms that they wouldn't normally have accepted. When I'm looking at financing, I really don't spend that much time looking at the interest rates by itself. I want to know what the monthly payment's going to be because that's the payment I'll be making every month. A loan can have an attractive interest rate and still create a payment that is not sustainable, especially if the purchase price is too high. I always look at the whole deal together. My purchase price, my occupant's payment, the property taxes, insurance, vacancy potential, and any other expense all have to come together and make the deal make sense. If I have to ignore one part of the numbers just to make the deal work, well, I have to move on. I also like having reserves before I buy. Look, occupants don't always pay exactly when they're supposed to. Sometimes they're late and sometimes life happens and payments stop for a while. Sometimes a property takes longer to sell. None of that changes the payment that I have to make to my lender. That's why I don't look at reserves as extra money sitting in the account. It is part of the investment and needs to be there from the beginning. One way I build those reserves is to keep the good portion of the occupant's down payment inside the business instead of treating it as income that I take out. That money gives me breathing room if something unexpected happens. And in real estate, something unexpected always happens. I also make sure my personal finance are in good shape before taking on another property. My investment business and my personal finances are, of course, legally separated, but they're still connected because I'm in between both of them. If something unexpected happens in my personal life, I don't want it affecting decisions I'm making about my business investments. I never felt the need to buy 5 or 10 properties right away at the start. I'd rather buy one property, learn from it, improve my systems, and then buy the next one. Every deal teaches you something. Every closing makes you a little more confident. Every lender relationship becomes a little stronger with every deal. That's also why you build credibility. Private lenders are much more comfortable investing with someone who has already completed 1, 2, or 3 deals, rather than giving them money for the first time on their very first deal. As Canadians, we're also learning a second system. We're dealing with cross-border banking, legal structures, title companies, insurance, currency exchange, managing properties from afar. There is really no advantage at all to rushing that learning process. Build the foundation properly, growth usually takes care of itself. People sometimes ask me whether they're financially ready to invest. I usually tell them that is something only they can answer. If your financing is already available, your reserves are in place, you've budgeted for the expenses that come with owning the property, and you can comfortably continue making your lender payments. If something doesn't go according to plan, then you're starting from a much stronger position than someone who simply has a few thousands of dollars in the account and are looking to jump into real estate investing. Look, it's really never about finding the perfect deal. It's always about a process that you can repeat and do that over and over again. Every property should be purchased the same way. The financing should always make sense. The numbers should work. The reserve should already be there. Once that becomes your habit, the portfolio will grow over time. So I promised you that I would try to give you an estimate, and so here it is. If you're buying a property, say around $40,000 US, I suggest you would have $50,000 ready to go. That will include all the money that you need to buy the property, but you also have to pay perhaps commission to the other agent side. You might have to pay certain closing fees. If you are also going into an area where the eviction process takes multiple months, you may have to put in reserve 3 to 6 months of reserve funding so that if the deal goes sour, if you will, for 6 months or so, you can continue to make payments over to your private lender. And the extra $2,000 or $3,000 is just good to have. So in general, if you're looking at a $40,000 house purchase, a good idea would be to have somewhere in the neighborhood of $5,000 to $10,000 available to you for reserve funding. So that may mean that when you're seeking your financial structure and you're lending, you're looking for more than what the house is worth. If you're looking to buy at 40,000, maybe you're looking for around 45 to 50, or at least having access to that extra 5 to 10 in some utility, whether it's a line of credit, some savings that you have, or a friend that you can call on if things get rough. I hope you enjoyed this lesson. If you're not quite ready for the full course and you want to use a practical tool to get started, you can download the free slow flip viability diagnostic. It will help you evaluate whether a property is a good fit for the slow flip model. If you are ready for the full course, you'll find the link in the description. And for a limited time, we still have some slots open to join the free cohort, where you'll be able to join a group of people who are learning the strategy all at the same time. It is a free cohort, but only accessible by application, and you will learn how to buy your very first slow flip. Hope you enjoyed, and we will see you in the next lesson. Thank you.